All right, in this lesson we're going to talk about stock valuation. Last time we talked about bond valuation. Here are the key concepts that we'll cover to understand how stock prices depend on future cash flows and to compute stock prices using we'll look at several models. Understanding how growth opportunities affect stock values. We'll look at the PE ratio and understand a little bit about how stock markets work. Chapter outline is basically what you see in your chapter. First of all, value of any asset, we talked about bonds last time, should be the present value of its expected future cash flows. Problem, of course, with stocks is that the cash flows are a little less certain. Cash flows come from dividends and capital gains, two forms. And we're going to look at three different valuation models. First is a model with dividends that never grow. They're constant forever. The next is a model where dividends grow at a constant rate. And the third is a model of differential growth, where perhaps we have one rate of growth for one period and then maybe the growth rate slows down. So first, zero growth. We'll assume that all dividends are the same. And let me point out here that we are assuming that there are cash dividends, and many stocks don't actually pay a cash dividend. So these valuation models sort of presuppose a company that pays a cash dividend. Since the dividends are constant, we have essentially a perpetuity, and we know that the present value of a perpetuity is equal to the dividend divided by the discount rate. So that's the price of the stock at time zero. Next, what if we have constant growth? In this case, each dividend is bigger than its predecessor by a factor of 1 plus g, where g is the growth rate. So 1 plus g, 1 plus g squared, 1 plus g cubed. In that case, we have a perpetuity that's growing, and we know that that's equal to the cash flow at time 1 divided by r minus g. So the price at time 0 is equal to the dividend at time 1 divided by r minus g. By the way, the price at time 1 would be the dividend at time 2 divided by r minus g. Price at time 2 would be the dividend at time 3 divided by r minus g, and so on. Now the constant growth example, let's suppose that we have a company that just paid a dividend of 50 cents. And I want to focus on that language, just paid a dividend. That's intended to communicate two pieces of information. First, it's intended to tell you that that's D0. And the reason we need D0 is we need a point of reference to calculate future dividends. And second, the just paid means that we don't actually receive it, and therefore it's not part of the calculation in terms of valuing the stock. But it is a point of reference. It's expected, the company's expected to increase its dividend by 2% per year, so the growth rate is 2%. The required return is 15%. We first map out the dividends, and dividend 1, we're after the price at time 0, so the dividend at time 1 is D0 times 1 plus g, or 50 cents times 1.02, and then we divide that by r minus g, or 0.15 minus 0.02, and this stock in theory should sell for $3.92. Now let's look at the third situation where we have differential growth rates. And in this particular instance, we'll assume that the stock starts out growing at perhaps a high rate and then at some point slows down to a more sustainable constant growth rate. We'll assume that dividends will grow at a rate of G1 for n years. N might be a short number of years, and then it will slow down to a rate of G2 thereafter. So dividend 1 will be dividend 0 times 1 plus G1. Dividend 2, dividend 1 times 1 plus G1, or D0 times 1 plus G1 squared. And we go all the way up to time n. And then from n to n plus 1, the growth rate changes to G1. So you see that the dividend at time n plus 1 is the dividend at time n times 1 plus G2, which is D0 times 1 plus G1 to the n times 1 plus G2. All right, now where we start here is we first draw ourselves a timeline, and we move out to the time where the dividend rate, where the growth rate stabilizes, which is time n. And we know that the value at time n, let's get the dividends down here. There's the dividend at time n, and here's the dividend at time n plus 1. The dividend at n plus 1 is the dividend at n times 1 plus G2. Now we know the price at time n is equal to the dividend at time n plus 1 divided by r minus G2. So we can first calculate the value of this annuity as the present value of its two pieces. The piece that grows at the rate of G1 and the piece that grows at the rate of G2. Here's the present value of the piece that grows at the rate G1. It's just an annuity that's growing for a period of T years, and that's the formula that we saw back in the last chapter. And then the part of the perpetuity where the growth rate is constant G2, the present value of that will be, we'll take the dividend at time n plus 1 divided by r minus g. That'll give us the price at time n, and then we discount that back n periods to time 0. Then finally, we add those together, and those two pieces together give us the present value of the entire stream of cash flows. Or we can cash flow it out, and I'll show you that more when we get to that specific example. So here's a stock that just paid a dividend of $2. So they're telling us that D0, which is a point of reference but not an actual cash flow, is $2. The dividend is expected to grow at 8% for 3 years, then it'll grow at 4% in perpetuity. Now, typically what I do is I go to the spreadsheet first, so let me do that. And for this particular problem, you'll notice that the growth rate is 8% for 3 years, and then it levels off to 4%. So all we need here is 4 years. So I'm going to make 1, 2, 3, and 4. Now, first thing we'll do is we'll put the cash flows in, the dividends for the first 4 years. So the dividend at time 0 is $2, and then it's going to grow at 8%. So we'll take 2 times 1.08 will be the dividend at time 1. And the dividend at time 2 will be 8% bigger. And the dividend at time 3 will be 8% bigger. Like so. And then at this point the growth rate changes and becomes 4%. So the dividend at time 4 will be equal to the dividend at time 3 times 1.04. Okay. Now the first thing we do is we find the price at time 3, and the price at time 3 will be equal to the dividend at time 4 divided by the discount rate, and the discount rate is, well, we don't know yet. Let's keep going. 12%, 0.12, minus the growth rate. And the growth rate from time 3 on is 4%. So this tells us that this stock is worth $32.75 at time 3. So what we really have done is we have changed this problem to the following problem. Let me add these two columns together and copy this. We have changed this to a stock that pays a dividend of $2.16 in year 1, $2.33 in year 2, and $2.52 essentially in year 3, and then sells for $32.75. So the total cash flow in year 3 is $35.27. And at this point, I can find the present value of these three cash flows at 12% using the net present value function, and the value is $28.89. Now I want to do this another way, a different, well, maybe I won't. Let's just leave it at that and go through the formula. If we stick these numbers in the formula, there's 2 times 1.08. That's 2 times, that's the dividend at time 1 divided by r minus g times this factor, which turns a perpetuity into an annuity of 3 periods. And here's the present value of the stock at time 3. That number up there in brackets is going to be $32.75, and then we discount it back 3 periods, and then we add those two pieces together. So we proceed this way, and we end up with $28.89, just as I did here. Okay, now with cash flows, this is a little closer to what I did. Remember I put in 4 periods. The dividend at time 1, dividend at time 2, dividend at time 3, and dividend at time 4. And then I use the dividend at time 4 to find the price at time 3. So I take that value there, 262, and divide by r minus g, And in this case, the R minus G is 0.12 minus 0.04. And so this 262 divided by 0.08 is the price of the stock at time 3. This is the dividend at time 3, the dividend at time 2, the dividend at time 1. Now since this is a dividend at time 3 and this is a price at time 3, I can add them. And what I end up with, basically what I did on my spreadsheet, 2889. So that's using cash flows. All right. And the value, price at time 3, $32.75. Now let's talk about estimates of parameters. Can we use the growth model to estimate growth? First of all, growth is equal to the retention ratio times the rate of retained earnings. So let's see if we can find out where the discount rate comes from. Discount rate can be broken into two parts, and I want to remind you of the discussion we had back when we talked about bonds. In the last discussion, we talked about a bond being equal to its current yield plus its capital gain or loss. Here we're going to talk about a stock being equal to the sum of its current yield plus its growth rate. And of course, finding the rate of return in practice is a little difficult because we really don't know what the future cash flows are or how risky they're going to be. But using the the Gordon or the discounted growth model, sometimes called the Gordon growth model, we start with the model that says the price at time 0 is equal to the dividend at time 1 divided by R minus G, and we just solve for G, and we solve for R, and R is equal to D0 times 1 plus G over P0 plus G, or simplifies to D1 over P0 plus G. Now the D1 over P0 is equivalent to the dividend yield, current yield that we had back in the last chapter on bonds. D1 over P0 can be thought of as the dividend yield, and G can be thought of as the capital gain rate, and together those two things make up the required rate of return. Now, I want to look at stocks from another point of view, and that is the present value of their growth opportunities. Growth opportunities are opportunities to invest in positive net present value projects. And conceptually, we can think of a firm as the sum of two pieces. One, the value of the firm if it had no growth opportunities, and we'll add to that the present value of its future growth opportunities. In other words, if the firm had no growth opportunities, it would not invest any of its earnings. It would pay out all of its earnings as dividends, and so the price of the stock would be the earnings divided by R. The dividend would be EPS divided by R. And then to that, we add the net present value of all future growth opportunities. So let's take a look. We now have two ways to value a stock: dividend discount model and the sum of the price of the firm as a cash cow plus its per share growth opportunities. Let's look at a firm that has an earnings per share of $5 at the end of a year. That would be D1. The dividend payout ratio is 30%, the discount rate is 60%, and the return on retained earnings is 20%. Return on equity, sometimes referred to. Now, first of all, the dividend will be equal to the earnings per share times the payout, or $5 times 30 cents, or $1.50 per share. And the retention ratio will be 1 minus the dividend payout ratio, or 70%, and the growth rate should be equal to the retention ratio times the return on equity, or about 14%. Now, we can now find, now that we have a growth rate, we can find the value of this stock. It's equal to the dividend at time 1, $1.50, divided by R minus G. The required return is 16, the growth rate is 14, and we come up with a value of 75. Now, what would this stock be worth, just out of curiosity, if it had no growth opportunities? If it had no growth opportunities, it would pay out the entire $5 as a dividend. In other words, the payout ratio would be 100%, the retention ratio would be 0, there would be no growth rate, and we would have 5 divided by 0.16. And so if the firm were a cash cow, it would be worth $31.25. But the firm does have growth opportunities, and it's worth $75. The difference between $75 and the $31.25 is $43.75, and the $43.75 is the present value of the growth opportunities. So if you look at this sort of messy equation here, let me talk about this just a little bit. This will take a little imagination, but you can visualize this. Remember, at time one we had an earnings per share of $5, and we paid out $1.50. That means that we reinvested $3.50 in the company. And on that $3.50, we're going to earn a return. That's a new level of equity, and the return on equity is 20%. And we're going to earn that 20% every year forever. And so it's a perpetuity. So 20% of $3.50 is like 70 cents. And if you take that 70 cents a perpetuity and find the present value of it, the present value of the cash flows is 70 cents divided by 16 cents. So what we have here in brackets is the present value of the future cash flows from a $3.50 investment minus the cost, or in other words, the net present value of the investment at time one. Now, what we're going to do is we're going to make a similar investment in this stock every year. This was the one at time one. We're going to make another one at time two, another one at time three, another one at time four. So we're going to have a perpetuity of investments, and we're going to have a perpetuity of NPVs. And it's going to turn out that these investments are growing at the rate of 14%. So if we want to find the present value of these net present values, we will take the first net present value and divide by R minus G, and that'll give us this $43.75. And that's how we come up with the net present value of the growth opportunities. The net present value of the growth opportunities, let me listen carefully, is actually the present value of a growing perpetuity of net present values. So we have a perpetuity of net present values, they're growing, and the present value of those growing net present values is $43.75. That plus what the stock is worth with no growth, $31.75, gives us the $75 value of the stock. Now, one of the most important ratios in all of finance is the price to earnings ratio. The price to earnings ratio gives us some sense of how expensive the stock is in relation to its annual earnings. And realize that it is a combination of a balance sheet number and a market number. And so it's calculated by dividing the current stock price, which is what investors have assigned to the stock, by its earnings per share. And usually investors use the last 4 quarters of earnings to calculate the earnings per share, although some investors like to calculate what they call the forward-looking PE ratio, which is next year's estimated earnings divided into the current price. So the PE ratio, price per share divided by earnings per share, and it is a measure of how expensive a stock is. Some investors, value investors, would generally like to find a PE ratio that's under 15, say. Some features of common stock. Common stock gives the shareholders voting rights, and there are 2 kinds of voting rights, especially when it comes to electing the board of directors. There's cumulative voting and straight voting. Cumulative voting allows you, let's say there are 3 different slots for investor, for a board of director. You can actually pull your votes for the 3 and vote them all for one of those slots. So you have a better chance of putting your own representative in one of those slots at least, and thus having some representation. If you have straight voting, then you're probably, unless you have a controlling interest, you're not going to be able to put your person in the position. Proxy voting just means having someone vote on your behalf. Most companies have several classes of stock. The most common are voting and non-voting. And stockholders have other rights. They have the right to share proportionally in declared dividends, and if there's a liquidation, to share proportionally in any assets that remain after the creditors have all been paid off. And they have a preemptive right, which means when the company issues new stock, they have a right to have their share of it. That way their position won't be diluted by new issues. Then we have a preferred stock. Now preferred stock is somewhere between common stock and debt. It's more like common stock in that it pays dividends, and it never matures, whereas debt matures. On the other hand, preferred stock typically can't vote for directors and for other important things, but it's a little like debt in the sense that the dividends tend to be large, more like coupon payments than like dividend payments. They do pay dividends. The dividend on preferred usually must be paid before dividends can be paid to common stockholders. Remember, dividends are not a liability of the firm, and they can be deferred indefinitely, but you cannot, again, pay common stock dividends until preferred dividends are paid. Most preferred dividends are cumulative, meaning if I skip $1 worth this year and I owe $1 worth next year, then I would have to pay $2 this year and next year before the common stockholders will get any dividends. Preferred stock generally doesn't get to vote. Talk a little bit about stock markets. I don't want to go into this a lot. The difference between dealers and brokers. A dealer is someone that owns stock and sells it. A broker is someone that acts as an intermediary. You can think of an auto dealer. An auto dealer has cars on his car lot, so he has an inventory. The New York Stock Exchange is the biggest stock exchange in the world. It's now publicly traded, and it has members. And the members, they used to own seats on the exchange, but since it's become publicly traded, they buy licenses, and there are only 1,500 of these licenses available. The most common of these types of brokers, trading licenses, is for commission brokers. There are about 500 commission brokers, and all they do is charge a commission to execute a transaction. Then there are specialists, and each specialist is assigned 2 or 3 stocks, and they're required to be market makers. And what that means is when nobody else is buying that stock, they have to buy it. When no one else is selling, they have to sell. So they have to make sure that there is an actual active market for stocks. Then there are floor brokers, and floor brokers once upon a time called $2 brokers because that's what they did. They're sort of independents, and they take the spillover from commission brokers and handle those exchanges. And then there are floor traders, and floor traders are members that actually act in their own behalf. They trade, buy, and sell for their own accounts. Don't want to say a little bit about much about operations, but basically operations are all about maintaining the flow of orders, an orderly flow of orders on the exchange. And then floor activity. Best thing I can do to describe floor activity is to refer you to one of the morning TV shows like CNBC or Bloomberg. CNBC quite often shows you a picture of the New York Stock Exchange, and you can actually see the floor activity going on, trading around the posts, people running around throwing paper and whatnot. Now, the NASDAQ is different from the New York Stock Exchange. You can actually take a field trip, go to New York and visit the New York Stock Exchange. But the NASDAQ is not a physical location. It's actually a network of computers linked together by which traders and dealers pass their quotes to each other. There are multiple market makers on the NASDAQ. In other words, unlike the specialists which are assigned a stock, there could be more than one person making a market in a particular stock on the NASDAQ. The NASDAQ works through an electronic communications network, and there are 3 levels of information. Level 1, which is median quotes. By the way, if you're interested in reading a lot more about this, you can Google it. If you look on something like, oh, I don't know, well, just Google it and you'll find tons and tons of information. Level 2 quotes, each of these levels gets a little more exclusive. Level 3 quotes are for dealers only. And a large portion of the technology stocks trade on the NASDAQ. This is a typical example of how a stock might be reported in the Wall Street Journal. Now you can find any of this information quite readily on Yahoo or Google Finance or on the internet. But this is a particular stock. The stock symbol is GPS, which is the gap. It's a 3-letter symbol, which means it's traded on the New York Stock Exchange. The 52-week high was $25.72. The 52-week low was $18.12. The stock pays a dividend of 18 cents per share per year, most likely. The dividend yield, which would be the dividend divided by the current price, is 0.8%. The PE ratio here is 18, little on the high end, but then maybe this stock has a lot of growth opportunities, which justifies a higher price. This stock traded 3,996,100 shares traded hands on the last day of trading. The stock closed at 31.35, and the net change, which isn't shown here but it would normally be shown, would be the difference between yesterday's close and today's close. A quick quiz then on this chapter. What determines the price of a share of stock? Well, generally the cash flows and the discount rate, and the cash flows are typically made up of a dividend and a capital gain, and the discount rate is made up of two components, which would be the dividend yield and the capital gain rate. What determines the G and R in the discount growth model? Well, the growth rate is determined by the rate of plowback. Remember that G was equal to ROE times the plowback ratio, and the interest rate R was equal to D1 over P0 plus G. We can therefore decompose a stock's price into constant growth and the net present value of growth opportunities, and you'll have a number of homework examples that ask you to do just that. Discuss the importance of the PE ratio. I did make the point that the PE ratio is probably one of the most important valuation ratios in all of finance. What are the major characteristics of common and preferred stock? And we went through those. So that pretty much summarizes our discussion of stocks.